Hello investors and traders. Today we'll speak about 3 dividend stocks that are up at least 25% over the last months, and all of them now pay a nice dividend. So let's start with the first stock. It's Caterpillar. Caterpillar is the world's largest construction equipment manufacturer. The company designs, develops, engineers and manufactures, markets and sells machinery, engines, financial products, insurance to customers. Also, Caterpillar is a dividend aristocrat, showing a nice commitment to shareholders throughout last 25 years of increasing dividend payout. And let's check it fundamental parameters of Caterpillar. We can see the total mark 84, quite high score. Let's check at financial stability. We can see the ratio of debt to EBITDA is only 3, so it's okay. Interest coverage is 17, so any problem with debt payment in the nearest future I don't see. And also the Altman's score is 3, above 3, so the probability on default in the nearest future is not high. So for me, I don't see any problems with that for this company. The gross margin, let's check the marginality. Gross margin about 30% and net margin 13%. So it's quite high. Also, please pay attention to the ROE, return on equity. So to the return for shareholders is 45%. So quite high percent. And also I think this metric is new one, years of profitability over past 10 years. It's here it's 9, so I think also this figure is showing us that CAT is a very stable company. Here, by the way, we can check the growth rank. We can see that the revenue, EBITDA and EPS earning per share last year's showed us a nice growth. And for the future, the EPS for the future, the forecast 3-5 years expected to grow about 10%, and the total revenue is also the analyst expecting that the revenue will continue to grow about 5%. So for me at least that it's positive figures. I think it's a very nice. And the value rank, P ratio current is 17, forward future is 16. So those ratios are are about the average for S&P 500 for this year. And the PS, please pay attention that PS, price per share, only 2. So we have a marginality about 13%. So I think the PS ratio from this point of view is at least not expensive. And the dividend yield, of course, we are always interested in dividends. The current yield is 2%, the payout ratio 13, so I think that CAT can even increase it, dividend payment to shareholders. And here the buyback of its shares, the company perform it, we can see. And also it's a very positive sign for the shareholders of this company. And let's pay attention to the chart. It's a weekly chart. So here the last year, in my mind, we had a range, decreasing range. Now as I see, we are getting out from this range, and in this case the probability, I can tell you the target, the target of this getting out, this can be 270, so it's my target. So from the current level, as I see, it's a nice potential to grow about 30-40%. So it, of course, it's my opinion, but anyway, Caterpillar is a very nice company, very stable. The industry, the construction industry, all this equipment, machinery, I think it's very stable now after the crisis, after the recession. I think that it's one of the companies that can show us a very nice growth. And also I'm not doubt that this company will continue to pay dividends. Let's move to the second stock for today. It's JPMorgan Chase. It's one of the largest financial service firms in the world, organizing its business through five reportable segments. And analysts have upped their earnings outlook across the board over the last several months. Also, GPM annual dividend yield currently comes to 3%, paired with a solid 13% 5-year annualized dividend growth rate and sustainable payout ratio of 34% of earning. Let's check JPMorgan fundamental parameters. We can see that the EBITDA ratio is about 3, but here the total mark is 3 from 10, yes, but we see that cash to debt ratio is about 2. It means that the amount of cash on the balance sheet is twice more than the debt. So if for example the company in 1 week 2 weeks from now will have any problems or any difficulties, so it can just take all the cash and with no problems pay all the amount of debt. So any problems, as I see, yeah, the net margin is 30 and ROI is also positive, and here the profitability for the last 10 years is 10, so it's also quite impressive. The projections are okay. P ratio 11, so yeah, it's much cheaper than Caterpillar. Here the forward P, by the way, is about 10, and the PS, if I'm not mistaken, the Caterpillar was 2, here PS 3, so also it's quite cheap. And the dividend here yield, of course, 3%, the growth rate is about 12, and the company also performed buyback, so don't forget that the buyback, it support the share price, and also it's a very positive sign. Let's check its chart. We can see now here 120 is the major support level, resistance level. If now we break it, as we see, it's a monthly chart. One candle is one month, so it's the second month that we are already breaking it. So in this case, there is a nice probability to show all-time highs. Yeah, it's all-time highs here. It was the beginning or at the beginning of this year. So most probably the target is could be here, yeah. And in this case, there is a nice potential to grow about 30%. So why not? It's financial sectors now. The interest rates about 4%. We know. Let me explain. When the interest rates are rising for the banks, it's better because how it's work for the banks. The net margin of them, yeah, it's different. It's the difference between the money that they are raising from people, from business. For example, the deposits now is about 1%, 2%, but the credits, the loans, they are offered to institutions, to businesses about 4. The mortgage now about 6-7%. So the difference between the loans they are offering to people, the mortgage, all the credits, and the deposits, it's the net interest margin for banks, for financial institutions. So now in high interest rate area, in these times, in this year, next year, it's supposed to be a very nice time for the banks. And let's move to the last stock for today. It's At&T. It's a North American second largest wireless service provider and one of the world's leading communication service carriers. We can see that P ratio of At&T now is only 7, and the technology market is current 22. So from this chart we can see that it's quite cheap stock in standpoint of valuation. I have a major share in this stock. AT&T is one of my favorites for the future years, so I like this stock very much. We can see that for a dividend yield, yeah, is about 6%. Market cap is it's quite big company. The payout ratio is only half, so 50% of its net income company pays as dividend. The earning for the future years is expected to be stable. The revenue also, yeah, it's quarterly. Let's move to the annual. Yeah, it's also expected to be stable. The dividend, yeah, it's grow. Yeah, the last 3 years, 5%, 7%, 8%. Now it's about 6. So I think that 6-7% in bucks, it's quite nice. Quite nice dividend. Also here in the quarterly basis, you can see that the marginality increase. So it's very good sign. It tells us that the management, the top management of company is working very efficiently. And by the way, the net income also is increasing. So yeah, I like this picture. And generally speaking, AT&T, it's a very cheap stock, because here the P ratio is only 7. So generally speaking, AT&T is one of my favorite stocks in this year. I like, of course, I'm a dividend investor, so I see also a nice potential to grow for this company. If we'll check the chart here, I think it was the fourth wave finished. Look, it was the first, the second, the third, and the fourth. And here the fifth is usually higher than third. So most probably we can see AT&T higher than 50 bucks from the current level is twice higher. So nice potential to grow, nice dividends, and also the valuation, the PE and PS ratio. PE only 7, so a very cheap stock for me. Why not? And by the way, their momentum indicator, their RSI, of course, after such growth. So here I will show you that last month the AT&T showed a nice growth, about 30%. So quite nice performance. Why not? Because here it was already very oversold. So if you like this video, don't forget to subscribe, press the like button, and see you on the next time. Bye.